Welcome to The Deep Dive, the place where we analyze massive structural shifts and try to extract the knowledge you need to stay ahead.
And today we have a big one.
We really do. We are deep diving into the world of basic apparel. So, t-shirts, socks, underwear, because the entire global supply chain is, it's seeing a massive consolidation event.
It's really a dual-story event, and you absolutely cannot look at one without the other. We're tracking the merger of two apparel titans, Gildan Activewear and HanesBrands.
Which creates a $7 billion giant?
Almost. A $6.9 billion giant. And at the exact same time, we're seeing this dramatic realignment in the distribution network. Specifically, Gildan striking a huge exclusive deal with S&S Activewear.
Okay, so let's unpack this. We've got manufacturing muscle merging and the wholesale ecosystem tightening up at the very same moment.
Yep.
Our mission today is to analyze the financial logic, the eye-watering synergy promises, and maybe most importantly, the resulting concentration risk for everyone downstream.
Right, for the little guys.
Let's start at the top with the mega merger. So, Gildan acquiring HanesBrands, or HBI. This was announced back in August 2025.
That's right. Gildan is basically swallowing up HanesBrands, valuing the outstanding shares at about $6 a piece.
And that $6 price tag, that wasn't just the market price, right? There was a premium.
Oh yeah, a big one. It represented an implied premium of roughly 24% over where the stock was trading before the announcement.
So not a cheap acquisition.
Not at all. It comes in at a total enterprise value of $4.4 billion. And assuming this thing closes, late 2025 or early 2026, the combined company is immediately huge.
And projecting what in terms of revenue?
They're looking at pro forma revenue of $6.9 billion.
Wow. Okay, so $6.9 billion in sales is massive. But the real story here, the thing that makes that $4.4 billion price tag work, it has to be the profitability they're projecting.
Exactly. They're anticipating a pro forma adjusted EBITDA of around $1.6 billion.
Okay, so for anyone who doesn't, live and breathe financial statements, break down adjusted EBITDA for us.
It's basically a very clean measure of the core operational profit. Earnings before interest, taxes, depreciation, and amortization.
Got it.
So that $1.6 billion in profit translates to an adjusted EBITDA margin of 23% for the newly merged company.
23%. Now, is that normal for apparel manufacturing? Because I hear that number and it sounds high.
It is absolutely not normal. That 23% margin is the key insight. It's industry leading. Most global apparel companies, they operate on much thinner margins because they're relying on third-party supply chains.
So who are we talking about, like their competitors?
Well, if you look at a company like Levi's, they're closer to 15%. Ralph Lauren is maybe 18%.
Okay.
The reason Gildan can do this, the reason they can hit that number, is their extreme vertical integration. They own everything from the cotton yarn to the finished shirt. This merger is basically about extending that low-cost advantage to HanesBrands' iconic portfolio.
That makes perfect sense. So they're betting their hyper-efficient supply chain can squeeze more profit out of Hanes' brand than Hanes could on its own.
That's the entire bet.
And that belief, that's what powers the most discussed metric in this deal. The synergy promises. We're talking about at least $200 million of annual cost synergies within 3 years. That number just feels enormous. Is it achievable?
That is the $500 billion question. I mean, $200 million is a very, very aggressive target. But to their credit, they've mapped it out quite logically.
How so?
They're spreading the gains pretty evenly across 3 areas: supply chain, operations, and SG&A.
Wait, can you just quickly remind our listeners what SG&A covers?
Of course. SG&A is selling, general, and administrative expenses. So think marketing, corporate headquarters, accounting, everything that's not directly making the product.
So you've merged two headquarters, you combine IT departments, you eliminate some roles.
And that's where a huge chunk of that SG&A synergy comes from.
Okay, so $200 million split across those three pillars: supply chain, operations, and cutting corporate redundancy. They've also given us a timeline, too.
They have. It's a phased approach. They expect about $50 million in 2026, then another $100 million in 2027, and the final $50 million hitting in 2028.
Which at least acknowledges how complex this is going to be.
Right. It's not a magic switch. That's often the biggest risk in these mega deals.
All right, let's move from the numbers to the strategic fit. Why did this particular marriage make so much sense? You mentioned Gildan's operational muscle, but HanesBrands brings something else to the table.
Oh, absolutely. It's a classic case of complementary strengths. Gildan's whole expertise is pure efficiency. It's low cost, state-of-the-art, vertically integrated manufacturing. They have 6 yarn spinning assets just in the U.S.
They're the engine of the wholesale printwear market.
Exactly. And then Hanes comes in with the brands and that direct consumer relationship. We're talking Hanes, Maidenform, Playtex, Wonder Bra.
These are iconic heritage brands with an incredible retail presence.
Unrivaled is the word.
Okay.
Hanes is the #1 innerwear brand in the U.S. And here's a genuinely staggering statistic for you.
Go on.
9 out of 10 U.S. households own Hanes products.
Wow. 9 out of 10.
That level of market saturation is a tremendous asset that Gildan is now buying. They're pairing the best manufacturer with one of the most recognized brands.
You know what stands out to me is how much this just completely alters Gildan's existing business model. I mean, Gildan was almost entirely skewed toward activewear and printwear.
It was about 90% of their revenue. But post-merger, that portfolio shifts dramatically.
The diversification is massive.
It gives them so much more resiliency. The portfolio becomes roughly 50-50 innerwear and activewear. But the channel exposure shift is, I think, even more fundamental.
How so?
Well, Gildan was heavily wholesale and printwear. The new combined company shifts to about 40% printwear and 60% retail.
That is a fundamental operational shift. I mean, you go from shipping pallets of identical white T-shirts to distributors to suddenly managing demand across thousands of physical retail stores, e-commerce.
All at the same time, the logistics become a war game, especially when you remember the new company has over 40 facilities and more than 90,000 employees.
Exactly. You accelerate retail penetration like this, and you just introduce immense complexity around, say, inventory allocation.
Right. You have to decide, should that box of socks sit on a store shelf for a walk-in customer? Or should it be in a warehouse for an online order promising next-day delivery?
It's the challenge of getting the right product in the right place at the right time while still making a profit.
And traditional models, they often over-allocate inventory just to be safe, but that just leads to costly excess stock.
So how do they handle this when they suddenly have 40 facilities to manage in this kind of volatile environment?
Well, they have to shift away from just hedging and embrace really sophisticated optimization software. You need systems that can model all the uncertainty balancing worst-case scenarios with best-case opportunities.
So making sure like a legacy Hanes facility in some far-flung location can actually fulfill a complicated e-commerce order without the shipping costs wiping out the margin.
You got it. And that level of operational efficiency is critical. It ties right back to that synergy number we were talking about.
Right.
If HanesBrands' old infrastructure isn't up to Gildan standards, they could burn through those projected savings just updating the equipment they need to manage the new complexity.
That's the core integration risk then. It's one thing to project $200 million in cost cuts.
It's another to invest the, potentially hundreds of millions required to modernize HBI's assets to actually deliver on that cost reduction without everything grinding to a halt.
That post-merger integration team has a monumental task ahead of them.
Monumental.
Shifting gears a bit, let's talk about how they're paying for all this. Gildan secured, what, $2.3 billion in financing?
That's right. And this, of course, brings up leverage. Their net debt leverage ratio is expected to be about 2.6x at closing.
Which is manageable, but a little high.
It's elevated, yeah. For context, that ratio signals risk. A higher ratio means more of your earnings go to paying off debt instead of growing the business or returning cash to shareholders.
And they have a target for that, right?
They do. Their long-term target is between 1.5x and 2.5x, so they're committed to getting that debt down. And fast. They expect to drop below 2.0x within about 12 to 18 months of closing.
Driven largely by those synergy savings, I assume.
Exactly. And the future growth, if they pull this off, it looks pretty aggressive. The 3-year outlook projects sales growth of 3-5% and an adjusted EPS TGR in the low 20% range.
It's also worth noting they're pausing share buybacks until that leverage is back in range. That shows a real commitment to paying down the debt first.
It's a disciplined move.
Okay, now we have to get to the second, equally massive story running parallel to this merger, the structural shakeup of the distribution layer.
This is huge.
This impacts wholesalers and screen printers directly.
This is the S&S Activewear deal. And it focuses right on the wholesale and printables market, the world where, custom apparel decorators get their blank shirts.
So what's the deal?
Effective December 28th, 2025. S&S Activewear gets exclusive U.S. wholesale distribution rights for Gildan's American Apparel brand.
Exclusive. And that's just the U.S. The Canadian angle's even bigger.
It's way bigger. In Canada, S&S Activewear becomes the exclusive wholesale distributor for Gildan's entire brand portfolio.
So that's Gildan, Comfort Colors, American Apparel, Champion, everything.
Everything. One distributor now controls almost everything Gildan sells north of the border.
But the real story here isn't just the brand names, it's the context. This is all happening right after S&S Activewear already made a massive acquisition.
Yes, their acquisition of Alpha Broader in 2024.
So let's rewind for a second. The wholesale and printables market, it was pretty much dominated by the big three distributors, S&S, Alpha Broader, and Sanmar.
Right.
And now, two of those three have merged into a single behemoth, this S&S Alpha Broader entity.
And that giant is now solidifying its exclusive relationship with the largest apparel manufacturer, Gildan.
This is a dramatic acceleration of market concentration. It has to matter hugely to the independent businesses and decorators who rely on these channels.
Oh, it does. And we've already seen the consequences of that initial S&S Alpha Broader merger.
Yeah.
We've seen facility consolidation, the closure of duplicate locations.
And streamlining the logistics network.
Yep.
Which, for the end customer, often means less choice.
Yeah.
Maybe longer shipping times in some areas and potentially higher prices down the line because there's just less competitive pressure.
Absolutely. The rationale for S&S and Gildan is obvious. It's about streamlining and leveraging massive scale. But the risk of, well, monopolization for the rest of the industry is immense.
That's the tension underlying this entire supply chain overhaul.
It is. When Gildan merges with HanesBrands, they're looking for $200 million in efficiencies through vertical control. When S&S consolidates distribution, they're seeking efficiency through scale.
But that quest for efficiency concentrates all the market power.
And that new entity can potentially dictate pricing and terms across the entire wholesale channel. The overarching narrative is clear. The whole basic apparel supply chain is just rapidly tightening up.
It's all about realizing these colossal operational efficiencies.
And for you, the key takeaway is that industrial logic just favors consolidation. The promise of combining manufacturing efficiency with brand power and distribution scale, that's what's driving all of this.
So let's end with a provocative thought for you to chew on. The entire value proposition of this Gildan-HanesBrands merger, it all hinges on that stated $200 million in cost synergies. We're talking about integrating over 40 different facilities, different brand portfolios. So considering that high level of complexity, especially with modernizing HBI's legacy assets, how much of that $200 million in expected savings has to be immediately reinvested back into the supply chain?
Just to stop the operational friction from eating the promised profits.
Exactly. It's a race between cutting costs and upgrading infrastructure.
Yeah.
And now, the part of the show where we pitch an outrageous but plausible trade idea. This is purely for entertainment, based on the narrative we just discussed.
And let us be clear, we are emphatically not financial advisors.
Definitely not. Please do not base your portfolio on this. Seriously, this is for watching the market dynamics play out, not for trading.
Okay, the outrageous but plausible trade idea is short Sanmar. Let's give it a hypothetical ticker, SMR.
Sanmar, the last man standing.
The last major independent competitor standing up against the S&S Alpha Broader distribution behemoth.
Right. The S&S merger already put immense pressure on Sanmar by giving the giant exclusive control over key brands like Bella Canvas and Next Level.
And now, S&S controls exclusive American apparel distribution in the U.S. and the entire Gildan portfolio in Canada.
So the plausible, though very aggressive outcome is that the concentrated distributor network uses its colossal scale and its vertical integration advantage to just aggressively undercut and squeeze the last competitor on service, on availability, on everything.
Target price set to zero, obviously, because we're talking about market dominance, not just a gradual decline. Something to watch as the distribution war heats up.
Thanks for joining us for the deep dive into the reshaping of the apparel industry.
We'll see you next time.